Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. You look at the headlines every day and the market just seems like, well, random chaos, doesn't it?
It really can feel that way, just noise.
But when we step back and actually analyze the deeper data, we start to see these huge structural shifts happening. It's almost like watching tectonic plates move. We've looked at the material, done the analysis, and really our mission today is to cut through all that noise. We want to give you a clear map of where capital is actually flowing right now.
That's exactly right. And these aren't just, passing trends or fads. These are confirmed long-term changes in global investing. We've sort of synthesized this into a new investment roadmap. It covers three really distinct areas. First, there's this total redefinition of China happening within global stock indexes.
Okay.
Second, the fundamental change in climate investment. It's really colliding head-on with geopolitics now.
And third, we're going to, take the rocket science out of some of these high-tech dreams. We'll look at that moment when the Robotaxi promise, meets the hard, simple reality of corporate balance sheets.
And their need for cash. Endless cash.
Right.
These three shifts really define the new landscape. They show where the smart money seems to be heading and maybe just as importantly, where it's running away from.
Okay, let's unpack this then. Let's start with that first one. The huge shift happening in global benchmarks. I mean, this is where trillions in passive investment dollars basically get handed a mandatory shopping list, right?
It really is. You could argue it's the most significant mechanical shift announced this year. The effective date for this massive MSCI index rebalancing. It's set for the close of market, November 30th, 2025.
Okay, so still a ways off.
Still a ways off, but the market is already reacting. And it involves 27 stocks being added to the index and 24 being deleted.
27 additions, 24 deletions. Now, if I just heard those numbers cold, I might think, okay, just some routine index housekeeping. But the analysis of which companies are moving, well, that tells a much deeper story, doesn't it?
Oh, absolutely. It tells the story of two Chinas. The index changes are basically confirming the government's strategic shift away from its old economic model.
Two Chinas. Explain that.
Okay, so look at the additions, what we're sort of calling new China, these companies. They're concentrated in really strategic areas. Semiconductors, chip manufacturing.
Right, the big push there.
Exactly. Robotics, AI, and even things like gold mining strategic assets.
Yeah.
These are the sectors that perfectly align with the government's big push for technological self-reliance.
That phrase keeps coming up, technological self-reliance. It feels very deliberate, very state-driven. How does that contrast with, say, the China we used to invest in 5, 10 years ago?
Well, in the past, the whole focus was on what you'd call quantitative growth. Think of that as China's economic story from maybe 2000 to 2020. Massive infrastructure projects. Remember the ghost cities. High-volume, low-cost manufacturing, the factory of the world idea. Immense lending fueling it all. It was all about scale, just getting bigger. Now, the government is pushing hard for qualitative growth. It's a different game. It's about quality, efficiency, and critically, owning the high-tech value chain. Making their own advanced chips instead of just buying them.
Okay, so the new China gets added to the index, and the deletions, the old China, well, they're the casualties of the strategic pivot.
That's precisely it. The 24 companies being kicked out are mostly in those old engines of growth. Real estate, traditional infrastructure, basic manufacturing.
The stuff that's under pressure.
Exactly. They face really strong structural headwinds because, frankly, the state isn't prioritizing them for capital anymore. The policy focus has shifted.
Okay, this brings up something interesting, this passive paradox. We know the effective date is almost a year away, November 2025. So if I'm a value investor, maybe I'm thinking, hey, those 24 deleted stocks must be cheap now. Why don't I scoop them up and wait for a turnaround? Why is that thinking maybe flawed?
That's a really crucial question, and it gets to the heart of structural shifts. The potential flaw is that they look cheap, but they could be classic examples of a value trap.
A value trap, like a mousetrap for investors.
Sort of. It's a stock that seems inexpensive based on its past performance, maybe a low price-to-earnings ratio. But its actual business model is on a structural downward path.
Yeah.
There's no catalyst for recovery. It's a bit like getting a huge discount on a typewriter factory today. Sure, it's cheap, but where's the future growth engine? It's gone.
So the index change itself is acting like a map, highlighting where that structural risk, that value trap risk, is highest. And at the same time, it's creating a kind of predictable trading opportunity for the additions.
Absolutely. It's a phenomenon often called front-running. Active fund managers, the ones trying to beat the market, they're buying those 27 new China stocks now.
Why now?
Because they know that by November 30th next year, hundreds of billions of dollars in passive capital, the index funds maybe sitting in your 401k must mechanically buy those exact stocks. It doesn't matter what the price is then or what the analysis says. They have to buy to match the index. This creates a predictable, very large demand spike down the road, and active managers are positioning themselves ahead of that wave.
It's pure supply and demand mechanics. That predictable demand means the price is likely to get bid up as we get closer to the date, simply because all these huge funds have their mandatory shopping to do. It feels like a very clean signal pointing investors towards aligning with new China's strategic sectors.
It really is. It's like a compass telling you where the government support, the funding, and likely the future growth concentration will be. Forget the old playbook.
That's a fascinating look at how state strategy directly moves markets. Let's use that idea, state influence, to pivot to our second major structural shift, climate investment. Because this isn't just about ESG scrolls anymore, is it? It feels like it's fully transformed into a geopolitical battlefield. You called it the Green Cold War.
That framing is spot on
Yeah.
because this whole area is increasingly dominated by conflict and competition. If you look at the global emissions data, our analysis shows developed markets, the DMs, have actually done reasonably well over the last decade.
Really? How so?
Well, they've managed to cut their emissions by about 18% while still growing corporate profits. That's mainly come from efficiency gains, regulation, compliance, basically optimizing the current system.
Okay, 18% reductions sounds good. But looking at the big picture, the total global emissions, that reduction hasn't really moved the needle on the overall climate challenge, has it?
Precisely. That's the problem. The main challenge, the biggest variable, remains with the emerging markets, the EMs, countries like China, India, Indonesia. They're in rapid growth phases.
Building things, using energy.
Exactly. They need vast amounts of energy, and often that's still carbon intensive. So their emissions are rising because they're still developing, building out infrastructure. Their transition, how they decarbonize, is arguably the single most critical factor for future global climate outcomes.
And this inherent tension, developed nations pushing for faster cuts, developing nations needing resources to grow it, really boiled over at the recent COP30 summit, which just wrapped up November 6th.
It did. The major sticking point was the loss and damage fund. Essentially, emerging nations argued that rich countries owe them huge amounts of public money, official development assistance, ODA, to compensate for climate impacts they didn't historically cause.
And the developed nations.
They pushed back, arguing that, public funds alone are just nowhere near enough to tackle a challenge this massive. The scale is astronomical.
So stalemate, or was there a compromise?
There was a very significant compromise, a real pivot in strategy. The final agreement strongly emphasized and really strengthened the role of private capital and multilateral development banks,
Yeah.
MDBs.
MDBs, like the World Bank.
Exactly. Organizations like the World Bank, regional development banks, this is a huge signal for you as an investor. Private capital is now officially seen as a necessary, integral part of the global climate solution. Not just nice to have, but required.
Okay, so money needs to flow. Now let's dive into the Green Cold War aspect. We've seen these aggressive trade actions recently. Why are things like solar panels and batteries suddenly such a flashpoint?
It really boils down to industrial policy, particularly China's. For years, the Chinese government heavily subsidized its domestic production of green tech, solar, wind components, batteries.
Made them cheap.
Extremely cheap. So cheap, in fact, that it effectively amounted to dumping in Western markets. They could sell below the cost of production for U.S. or EU manufacturers.
Which undercut those Western companies?
Severely damaged them. Many couldn't compete purely on price against state-subsidized imports.
Sounds like a classic recipe for a trade war.
It is, and we're seeing it escalate right now. The EU was already investigating Chinese solar firms for subsidies.
Yeah.
And just recently, on November 4th, they officially expanded that anti-subsidy investigation to include wind turbines as well.
So it's broadening.
It confirms this trade conflict is deepening, spreading across the whole green technology spectrum. It's not isolated.
Right. And here's where I think it gets really critical for investors. If the price of a solar panel or a wind turbine is being distorted by government subsidies on one side, and then potentially hit with tariffs or protected by regulations on the other, you can't just analyze it like a normal technology investment anymore, can you?
You absolutely cannot. You're not just buying technology, you're buying geopolitics. Green tech has fundamentally become a geopolitics investment.
Wow.
The number one question for investors shifts. It's no longer just, is this the most efficient solar panel? It's now, which government's protection, which government subsidy is this specific technology benefiting from?
So the policy itself becomes a kind of financial asset, like a protective shield for the company.
Exactly. Think of it as a policy moat. If a company benefits directly from, say, the U.S. GPS Act, or the Inflation Reduction Act, the IRA, or specific EU guarantees and protections, that policy creates a moat around their
A
business.
moat against what?
Against that flood of low-cost, state-subsidized Chinese competition. It might mean their product isn't the absolute cheapest on the global market, but they have guaranteed access or support within their home market. It's like having a protected bike lane next to a superhighway full of trucks.
Slower, maybe, but safer passage.
Guaranteed passage, essentially.
Yeah.
And that policy protection adds real, measurable value and stability to the company. It fundamentally changes the risk profile.
That completely reframes the due diligence you need to do.
It really does. And another key point here, follow the capital flows towards what we call transition leaders. The market data is showing that premium valuations, higher stock prices, are going to companies that demonstrate clear, measurable decarbonization transition plans.
And this isn't just green energy companies.
No, regardless of their industry. If a steel company or a cement company has a credible data-backed plan to decarbonize, investors are rewarding that.
Oh.
Also, look for companies solving the structural bottlenecks. Things like upgrading the power grid to handle renewables or energy storage solutions. Sometimes it's much better from an investment standpoint to bet on the essential plumbing rather than the flashy new faucet everyone's talking about.
The plumbing, not the faucet. I like that. That's a great principle.
Yeah.
Okay, speaking of essential components and government influence, let's move to our third big structural shift. The reality check hitting high tech. Specifically, let's analyze the post-IPO world for these Chinese robotaxi companies, like WeRide and Pony.ai.
Yeah, the hype bubble here definitely seems to have popped or at least deflated significantly. These companies went public with enormous expectations. I mean, Pony.ai's IPO was reportedly oversubscribed, something like 16 times. Huge excitement. But those sky-high expectations quickly ran into, well, operational reality. The stock prices for both are still way below their IPO levels, and the Q3 earnings reports, they were a dose of cold, hard reality.
But I saw some headlines. Pony.ai reported revenue growth of, what, 120% year over year? That sounds amazing. What's the problem with that?
The problem is the other side of the ledger, the cost structure. Yes, revenue is growing impressively fast, but the spending on R&D, scaling up the vehicle fleets, global expansion efforts, it means their cash burn rate is increasing even faster.
Ah, the cash burn rate, how quickly they're spending money.
Exactly, how fast the cash pile is shrinking. This industry is proving to be an incredibly capital-intensive marathon. Raising that big chunk of IPO money, that was just like the first water break in a very, very long race. They need continuous, enormous funding just to keep running.
So that flashy revenue growth number is almost meaningless if they're burning through cash faster than they're bringing it in. Okay, so if it's a marathon, we need to look at how they're running it. Are their strategies different?
Absolutely. And their diverging strategies offer potentially different investment angles. WeRide, for instance, seems to be focusing very aggressively on internationalization.
Going global.
Yes. The big news recently was them securing a major contract in the UAE, in Dubai specifically, to supply 500 robotaxis by 2026. They seem to be actively positioning themselves to capture markets in the Middle East, maybe even getting ahead of U.S. competitors who are still very focused on the complex U.S. domestic market.
Interesting. And Pony.ai, what's their angle?
Pony.ai looks to be doubling down on the domestic Chinese market and, critically, leveraging policy changes there. Their focus is more on standardization within China.
Standardization? How so?
Well, on November 3rd, the Chinese government released new guidelines that effectively standardize the operating licenses needed between major robotaxi test zones, like Beijing and Shanghai. This is potentially huge for companies focused domestically.
Why is that so huge?
Because it dramatically simplifies the regulatory pathway to scale up operations across different major cities. Think about the U.S. companies have to navigate complex, often conflicting regulations state by state, even city by city. It's a patchwork.
Right, very fragmented.
In China, Pony.ai and others now potentially have a government-smooth path to scaling much more rapidly within that massive domestic market. Policy is paving the way.
Okay, so it's like two different races. The U.S. game is about navigating regulatory complexity for arguably a higher value per customer market. The Chinese game, for Pony.ai at least, is leveraging policy simplification to achieve scale, while WeRide is using that scale as a springboard for international dominance.
That's a great way to frame the split. And because of this capital intensity, this marathon, you have to look past the short-term revenue growth. The absolute key survival indicator you need to monitor is cash runway.
Cash runway, meaning?
Meaning, at their current cash burn rate, how many months or quarters can they actually survive before they run out of money and need to raise more? That single metric will likely differentiate the survivors from the eventual casualties in this incredibly expensive race.
Okay. So the immediate takeaway here feels like international wins, like that weird-eyed contract in Dubai, are really critical differentiators right now. But maybe the biggest long-term opportunity isn't chasing the hype, but waiting for that cost reality to fully sink in across the sector. Maybe when valuations of the less capitalized players really get hammered.
Well, volatility always creates opportunity, right?
Yeah.
But only for those companies that actually have a long enough cash runway to survive the storm. Many won't.
This has been incredibly clarifying. Okay, let's quickly try to summarize the three major structural takeaways that are really defining the investment landscape right now, based on our analysis.
Okay. First, that MSCI index rebalancing clearly confirms the pivot from old China to new China. Investors really need to see old China sectors like traditional real estate as potentially high-risk value traps now.
Right. Don't get caught by cheapness.
Second, climate investment is the green Cold War. It means policy analysis isn't optional anymore. You absolutely have to look for companies benefiting from a government policy mode for protection and stability.
Okay, policy as a shield.
Right.
And third.
Third, in these super high-growth, high-tech sectors like robotaxis, ignore the flashy revenue headlines. Focus relentlessly on the cash burn rate and the cash runway. It's a survival contest defined purely by capital endurance.
Endurance is key. That sums up the map really well.
Yeah.
Now, you mentioned having one final thought for listeners to chew on.
Yes, just something to consider as you think about all this.
Yeah.
When you're investing in these really powerful long-term structural trends, whether it's decarbonization, AI, robotics, whatever it might be, instead of always betting on the most visible end product, the solar panel itself or the flashy robotaxi,
Yeah.
consider the structural bottleneck that entire trend depends on.
The structural bottleneck. Okay, give an example.
Right. So for decarbonization, a huge bottleneck isn't always generating more solar power. It's often the aging electrical grid infrastructure that can't handle intermittent renewals effectively, or the massive energy storage systems needed to balance supply and demand.
The plumbing again.
Exactly. Or for robotaxis, maybe the bottleneck isn't the car itself, but the advanced sensor technology every car needs, or the high-definition mapping platforms they all rely on, or even the specialized insurance models that will have to emerge to cover them. Betting on those foundational bottlenecks, the enabling technologies or infrastructure that everyone in that growth area will eventually need. That often offers a potentially more stable, less volatile path to long-term growth.
Look for the essential foundational piece that enables the trend. That is a powerful thought to end on. Thank you so much for guiding us through this deep dive today. Don't forget to subscribe and hit that like button.